वेलकम टू वी लर्न में आपका स्वागत है। सब्जेक्ट इंटरनेशनल बिजनेस फाइनेंस, सेशन नंबर 15, फाइनेंसिंग इंटरनेशनल प्रोजेक्ट्स। टॉपिक कवर्ड इन दिस सेशन: कैपिटल बजटिंग डिसीजन and its concept, cost of capital and its concept, various concept of cost of capital, financing foreign project, and now capital budgeting. Capital budgeting requires estimation of a project's incremental cash flows, which are determined by estimating worldwide cash flows with and without the project. There are two main methods of international capital budgeting. Number one, centralized, and number two, decentralized. Centralized requires exchange rate forecast and decentralized require a local currency cost of capital. The method a firm selects should depend on its comparative advantages in estimating each of them. Cost of capital. CAPM determines a project's equity cost of capital. It prices only the systematic risk of the project. If risk premia are identical and uncovered interest parity holds, the only difference between home and foreign cost of capital will be anticipated exchange rate changes. In this case, centralized and decentralized capital budgeting will deliver identical results. The foreign cost of capital will perform dual role of discounting and adjusting for anticipated exchange rate changes. If anticipated deviation from uncovered interest parity exists, centralized capital budgeting will deliver higher returns when deviations are positive and lower when negative. Centralized is also easier to implement if UIP fails. If investors do not hold worldwide market portfolio, decentralized capital budgeting will raise real capital cost and thereby lower project NPVs because foreign investor portfolios will co-vary more with project returns than home country investor portfolios. Country specific risk. Country like Australia, Hong Kong, Singapore, United States. Correlation with US market in the terms of Australia 0.46, Hong Kong 0.30, Singapore 0.45 and United States is 1. Standard deviation of return in percentage for Australia 86.46, Hong Kong 110.87, Singapore 85.29, United States 49.52. Beta from US perspective for Australia 0.80, Hong Kong 0.67, Singapore 0.78 and United States is 1. Adjusted present value. If incentives exist to finance with debt, tax shield or interest subsidies, adjusted present value APV should be used. If tax treatment are symmetric and if uncovered interest parity is expected to hold, tax shields will have identical value whether debt is raised in host or home country. Low capital gains taxes, high deductibility of interest payments, negative failure of UIP and subsidized interest rates will all favor financing in depreciating currencies. Political risk. Centralized capital budgeting requires expected cash flows to be adjusted for political risk, not cost of capital. Foreign political risk is unlikely to be systematic to the risk of domestic shareholders' portfolios. Sensitivity analysis is an alternative to calculation of exact political risk probabilities. Solve for probabilities that sets NPV equal to 0 and then ask where or whether it's reasonable. If so, NPV is quite possibly negative. Financing foreign project. Financing source of the project is internal source and external source. Financing internal source and external source, like internal debt and equity, external is also debt and equity. Financing internal and external debt and equity, and debt is home currency debt, then foreign currency debt, then equity is also home currency equity, foreign currency equity. Internal debt versus internal equity. The primary trade-off between internal debt and internal equity center around taxes. If internal debt is used, interest payments made from the subsidiaries to the parents are treated on a pre-tax basis in the host country. If internal equity is used, dividends repatriated from the subsidiary to the parents are treated on a post-tax basis. Generally, home country gives a tax credit on foreign taxes paid on repatriated dividend of up to but no more than the home country tax bill on the dividends. Internal debt versus internal equity. MNCs using internal financing will have greater incentives to use debt. Number 1, the more volatile are parent earnings, higher probability of negative parent earnings means better chance interest payment will be untaxed. Number 2, the less volatile are subsidiaries earning, lower probability of negative subsidiaries earning means less chance subsidiaries will be forced to make interest payment out of negative earning that are taxed at the parent. Number 3, the larger the host country tax rate compared to the home country, larger host country tax rate means larger potential tax shield. Financing like internal and external. Internal means internal debt and equity. Internal debt equal to national debt and foreign debt. Equity is a domestic equity and international or foreign equity, same as external debt and equity. The trade-off between external and internal financing will be largely similar to those in domestic context. Issuing costs. Number 2, asymmetric information cost. Then financing internal and external debts and equity. Tax shield, interest subsidies. Additionally, the monitoring benefits debt may add over equity addressed in a traditional finance setting will be applicable here. So, financing internal and external. Internal classified in debt and equity. External is also classified in debt and equity. Equity may be home currency or foreign currency. Debt may also be home currency and foreign currency. Internal equity is also home currency and foreign currency, and debt is also home currency and foreign currency. Home versus host country equity. Home and host currency cost of equity capital would identical if uncovered interest parity held and if all investors held diversified world market portfolio. Where investors hold domestically biased assets, host country cost of capital is likely to be higher. The project will likely have higher correlation between its returns and the local economy. From the host country investor perspective, the project will contain more systematic risk. From a political risk standpoint, issuing host country equity is likely to have two divergent effects. Number one, political risk, probability of expropriations are likely to be reduced. Number two, political risk are likely to be more systematic to risk of host country shareholders' portfolio. Now financing, like as previous slides, and then international debt financing. Debt denomination decision is often cast in the same terms as international capital budgeting, like as centralized techniques and decentralized debt financing. An MNCs which borrows primarily in the home country is said to be centralized debt financing. Through an MNC certainly can centralize debt finance in many single country. An MNC which undertake borrowing in countries where operations are located is said to be decentralized debt finance. International debt financing, second, ex ante deviation from UIP makes centralizing debt finances attractive. If a given currency's low interest rates are not expected to be offset by appreciation of that currency, firms that can access the low interest rates and centralized debt finance, there will be profit. Even if UIP holds ex ante, MNC will generally have differential access to markets. Put simply, domestic firms usually enjoy lower interest rates in home country debt markets than foreign firms. The debt denomination decisions. If a firm borrows in domestic rather than local currency, it faces greater exchange rate risk. The cost of financing in the local currency will consist approximately of the local currency interest rate, premium, and the expected exchange rate change. The differential can be interpreted as the extent to which the firm accesses a home currency financing advantage in excess of anticipated exchange rate changes. This will be traded off against the larger exchange rate risk of home currency financing. Example, GM and Auto Jazz. GM will invest $500 million in Auto Jazz, an auto plant located in Zaporizhzhia, Ukraine. With the investment, Auto Jazz will produce 250,000 cars for domestic sales annually. GM expect to receive a return of $3,300 per cars. The Ukrainian carbon currently traded at $0.741 cars. Ukrainian inflation is 35%. Ukrainian interest rate are 40%. US interest rate are 5%. GM accesses Ukrainian debt markets by a factor of 7% above risk-free rates and accesses US debt markets by a factor of 5% above risk-free. Should GM finance with carbon or dollar debts? And key points of the example: primary trade of internal debts versus equity is between the tax shield benefits of debt and the flexibility of equity dividend repatriations. Number 2, firms will tend to favor debt when parent earnings are volatile, subsidiary earnings are certain, and subsidy tax rate are high. Number 3, with external financing, debt provides advantages over equity to the extent it offers tax shields, interest subsidies, and monitoring benefits. Number 4, when financing with external equity, firm will likely face higher equity cost of capital in the host country market. Number 5, local equity will also often alter the magnitudes and pricing of political risk associated with the project. Number 6, in the debt denomination decision, an MNC which centralizes borrowing in home country is likely to get more favorable rates. Number 7, MNC which borrows in the currency of the project produce a natural hedge, offsetting project returns with debt obligations, and hence facing less exchange rate and political risk. And now, do it yourself. What is the concept of international debt financing? And that's it from session number 14. Thank you.